You may have seen that I originally said we don't have class next week. We actually do. So there's good news and bad news. The bad news is you thought you weren't going to be here, but you will. The good news is that's an extra chapter that's going to be on the take-home test rather than an extra chapter for in-class. So I think overall, hopefully you see that as a net positive. If not, nothing I can do. Today we have accounts receivable and sales. They're treated together because they go together usually as a pair. You make a sale, debit accounts receivable, credit sales. Technically, we're talking about credit sales. We also could have debit cash credit sales. Those would be cash sales. And we usually treat the sales differently. We usually want to separate credit sales from cash sales. Now, for most businesses that sell to the public, like McDonald's, you expect most of their sales to be cash sales. And most businesses that sell exclusively to other businesses, most of their sales are credit sales. So we go into McDonald's, we buy something, we pay cash sale. What is it if we use a credit card? Okay. It's a cash sale also. Why? Because it's not the fact that we're using credit as a customer, it's that the person selling to us isn't the one providing the credit. In order to be a credit sale, the seller has to provide the credit.
So if you use like a Macy's or Bloomingdale's credit card and you're deriving credit from them, then it's considered a credit sale?
No, that's still a cash sale.
Cash sale?
Yes, you know why? Because it's not the store that's giving you the credit.
It's the corporate.
It's the financial corporation that happens to have Macy's. You also see it, Ford Motor Credit, General Motors Credit. Those aren't the dealership. The dealership is actually selling the car, if you're leasing it, to the lease arm, and they're the ones leasing you the car. Or if you're buying it on a loan, it's the financial credit company that's providing it, even if it has Ford or GM in the name. It's not the dealership. Now, there are cases where you go to a place that gives you credit, and it can be that the seller is providing the credit. It's just usually it's not. Two other terms, sales returns and sales allowances. Anybody know what a sales return is?
That's when someone returns something.
It's as simple as that. Yeah, you return something. And what's the difference between that and a sales allowance?
That's the amount of loss you're taking on it.
Kind of.
Like with check by allowances, like how much you're not going to recover.
No, that's different. That's definitely not
call
that.
an allowance, but so it's not the amount of your percentage you're losing on that.
No, that's different.
Is that what you're allowed to negotiate?
It's more like a price adjustment. One time I bought this table, dining room table, and it was supposed to be 6 feet. And they delivered it, and it was a couple of inches short of being 6 feet. Now, you might say it's a small thing, and maybe it is, but I measured it in the store, and it was 6 feet, so I kind of felt cheated. So I called the store and said, I got this problem. I bought a 6-foot table, and you delivered something a little shorter. And they said, well, if you want, we could come take it back, or how about if we give you something off the price? So that would be a sales allowance. Now, if they delivered a bunch of stuff, and I said, some of it I don't want, it's damaged, take it back, that would be a sales return, because some of the merchandise went back. A sales allowance is just an adjustment of price.
Is it the same as like a discount or different? Can we count discount as allowance or not?
Discounts are something different that we'll get to in a second. This sales allowance, just think of it as an after-the-fact price adjustment. If you walk in and say, you want $50,000 for this car, I'll give you 48. It's not a sales allowance. It's a sale at 48. The allowance has to come after the sale. So on the income statement, we would have sales, less sales returns, less sales allowance equals net sales. Sales returns and sales allowances are contra accounts. Anybody know what a contra account is?
It's like a purposely negative account. Or it would carry a debit balance on the income statement.
It's pretty good. It's an account that has a balance that's opposite the normal balance. So a revenue account usually has a credit balance. Sales returns and allowances has a debit balance. So because the normal balance for a revenue account is a credit, and these usually have debit balance, it's called a contra account. If it didn't have the debit balance,
Can they mail that as one?
I'm not sure it's them. I'm wondering if it's me.
Really?
Does it happen other than when I'm talking?
Yeah. Just make noise. It does it.
Oh, so you're agreeing with me.
Oh, when we make noise.
Ah,
So it's you.
Yeah, it is.
Maybe I'll turn the, see if I can turn the mic down a bit. Still happening?
Not so much.
A little better? Yeah. We'll see what happens. So we make a sale on credit of 1,000, debit accounts receivable, credit sales. Somebody's unhappy, maybe someone else didn't like the size of their table, so they're gonna get $200 off, they take it. We debit sales allowance, we reduce the accounts receivable by 200. So this is it for the period, and we want to make an income statement. Sales are 1,000. Sales allowances are 200. Net sales are 800. Now we're getting to a third topic. It's called sales discounts. Sales discounts usually have a notation that looks something like that would be read 210 and 30. What does the 2 represent?
2%.
2%. 2% what? 2% discount.
It's paid within 10 days.
Percentage discount if paid within 10 days. The end means
Full payment within 30. Is that usually how like a discount would be denoted? The numerators, the discount amount, is it always 2 over 10? Or 1 over 9 over 10?
you know, when I say always, this notation, yes, but you may get a bill from someone and it
Right.
says, if you pay in 10 days, take 2% off. There's no slashes and
Is
commas.
this textbook convention or?
This is, and you do see this a lot. Some invoices have a box, discount,
Yeah, friends and family discount, of course.
something like that. But this is the notation we're getting used to. And if you can understand this notation, you can understand it no matter the framework they use. So you get a 2% discount if you pay within 10 days. If you don't take the discount, then they expect the full amount within 30 days. Now, this is not prescribed by law. This is just simply what any seller wants to offer. So you could see anything. You could see 1% paid within 40 days, the balance within a year. You're not going to see that, but you could. There's no rules for what you're going to see there. So March 1st, we make a sale. The sale is for $1,000. We debit accounts receivable, credit sales, and the sales discount terms were 210 and 30. The customer pays on March 3rd. How much are we going to debit cash for?
2%.
980.
980, right? 98% of the 1,000. How much are we going to credit accounts receivable for? 980 or 1,000. Well, after making this payment of 980, how much does the customer owe us?
Still have a discount.
He owes us nothing, right? So we have to get rid of the whole 1,000.
Is it 200?
20, not 200.
20 debit sales discount?
Yeah, sales discount. Now, there's 2 methods for recording sales discounts. This is the gross method. In the gross method, we assume the customer is not going to take the discount, and we only record the discount when they avail themselves of it. The other method is called the net method, and we won't illustrate that. If you were an accounting major, you would need to know it. But just in general, I'll tell you about it. In the net method, we assume the customer will take the discount. So we would have debited accounts receivable 980, credited sales 980. So if they do get the discount, we debit cash 980, credit accounts receivable. We only have to worry about that adjustment when they don't take the discount, when you use the net method. With the gross method, we only have the adjustment when they do take the discount. Any questions about this concept? So let's do one example. so April 7th, we sell 400 units of something at $20 per unit under the terms 110 and 60. On 4/8, the customer returns 100 of the units. We agree to take them back. And on 4/10, the customer pays the balance due. So what are the entries we need? I'll give you a second to try to work through it, then we'll go over it. $1,900. That's just a random number you're throwing out there?
I think credit account receivable for $5,940.
Well, this is 3 separate transactions we need to record, so just giving me like the end number isn't going to be that helpful at the moment. So let's start with the entry we need on April 7th.
Sales.
Debit or credit?
Credit revenue on 8,000.
So 400 times 20 is 8,000. What are we going to debit?
Debit return inwards 2,000.
Well, you probably want to debit accounts receivable.
Right.
Then on April 8th,
Returns 2,000.
what are we going to credit?
Account receivable. Discount.
410? You want to start with the discount?
Yeah.
Okay.
$40.
$40.
$60.
$60. Do I hear 80? Why don't we can start with the discount. How much is the discount?
1% of the remaining amount.
1% of the remaining amount.
6,000.
So accounts receivable starts at 8, reduced by 2. Now that payment is going to be made, it's being made on a balance of 6,000. So we can take off 1% of 6,000, which is 60. How much do we credit accounts receivable for?
660.
6,000.
Yeah.
6,000. So how much is the amount of the check we're going to get?
5,000.
Debit cash, 5,940. So whenever we have a return between the sale and the payment and a discount is applicable, we have to remember to subtract the return or the allowance from the accounts receivable balance. maintenance. That's the takeaway from this problem. Now, here's a practical consideration. This is your business. Instead of getting the check on the 10th, let's say we get the check on the 20th. And the check is for $5,940. What do? How much should we have gotten?
60.
Should have gotten $6,000 because it's outside the 10-day period. It's 3 days outside the 10-day period. Do you go back to the customer for the $60? He said no.
Depends how well you know that.
Well, if you know him very well.
No, you eat it.
See, I'd say the opposite, right? If you don't know them very well, it means they're probably not a big customer of yours. And what's the likelihood they're coming back if for 3 days you go after them for the discount? The whole idea of the discount is to get the payment faster. It's the only reason you're doing it. Now, is 3 days that big a difference when you're willing to wait 60 for the full payment? No, chances are, if you're trying to encourage them to pay sooner, and they say, for 3 days, weekend might have been involved, maybe they didn't get their mail on time, I might as well take the full 60. You'll never get anything if you're going to be like that. You ever take a coupon into a store that's been expired for a couple of days?
Oh, yeah.
They take it?
Oh, yeah.
They should.
Yeah.
The whole point of marketing and paying for putting coupons out is to get people in to use them. And when they do, the last thing you want to do is discourage them from ever coming back. Now, there are some things you don't want to do, especially as easy it is to make up fake coupons. Oh, this coupon says I get unlimited hamburgers for $1. You're probably not doing that one. But if it's expired for a couple of days and it was a legitimate coupon, honor it. But that's not really accounting, that's business. So I would generally, if it came in a little late, I would generally accept it. Now, as we make all these entries, debiting accounts receivable, crediting sales, we're going to have this big accounts receivable account with all the debits in there and all the payments as credits. In real life, that's not so helpful to a business. Because the question is, which customers owe you how much money? And if all you have is this big account, you really don't know. You're going to have to go through and take all the debits and credits and parse them by customer. So really what this is the general ledger account for accounts receivable. And that's a control account. That's going to have some balance. Somewhere else, we need more T accounts or ledger paper or some way of keeping track. Whatever our customers are, ABC company, DEF company, Sophie company, whoever our customers are, we need to have their own running balances. So if this balance is 1,000, then the sum of these balances needs to be 1,000 also. So the control account equals the sum of the individual accounts. Computers do this automatically. When I enter debit accounts receivable, credit revenue, on the receivable line with computer systems, I'm required to enter a customer name. So it could put that balance to the customer's account. And when the customer makes a payment, I apply that payment to that customer. It reduces the individual customer's balance as well as keeping the control account equal to the sum of all the individual customer accounts. Now, in the general ledger, we don't want one of these for every customer. Just makes it too big. We just want to see one accounts receivable account. And when we want to do something, we go to what's known as the subsidiary ledger. Now, I can't believe I'm old enough to say this, but back in the day, the subsidiary ledger was a separate book. Yeah. And I would take that and total it and make sure it equaled the accounts receivable control account in the general ledger. With computers, all you do is double click. Yeah, but if you have paper, what do you do?
Look at the subsidiary ledger.
Having started without computers makes me appreciate the inner workings more.
I'm sure.
I used to, when I was in college, undergraduate, I worked for an accounting firm. And they had some really small clients. One of them was a meat packing company. And right around middle of January, after the December bank statement came in, they come in with their records. And their records were 12 unopened bank statements. They would give me their records, and I would have to make their books. So I'd open the bank statements, all the deposits were revenue, all the checks were expenses, and I had to figure out where they were and where they went. And it wasn't so bad. That's really starting from the bottom and by hand working everything up. The only thing I didn't like was this thing smelled like bacon. And for a week or so it took to do this. That's all unprocessed bacon. Yeah. But you really start from the beginning. You understand what happens inside the computer. And I appreciate it, and I'm glad I don't have to do it by hand. So that's the way this works. Now let's take one particular customer. And let's say, what's today? Today's December 15th. That's been owed since September. Do we think we're going to collect it? Yes or no?
No.
Really?
We don't think we're going to collect it.
Because it's only 3 months old.
Depends on the term of the loan. Depends on the term of the credit. Depends on the term of the credit.
Yeah, but we really, I mean, a lot of times we do a lot of in-depth analysis before we grant credit. This is $400. How much work did you think? We just made sure it's a legitimate business. Yeah.
Are they still in business?
Still in business.
And they're still doing business with us?
Still, well, no, because we're saying that's the balance and that's from September. So either they paid for everything else, more likely you paid for the oldest first. So let's assume they haven't done business with us since September.
Our town is big. Not that I have $4 our town.
Okay, September, how about, it's been owed since June.
I guess now that's more likely not.
So you're leaning towards not. How about
Taking it
March?
to September, yeah, okay.
So the longer we go, the less likely we're going to collect it. The question is, when do we decide we're not going to collect it? Because if we leave all the money we've owed but haven't been paid on the books, these subsidiary accounts are just going to keep growing. Now, we'd like to think that we always get paid, and some businesses always do, but there's bound to be some that don't. Suppose the business closes down. Suppose they move and your bills don't get to them. Suppose they go bankrupt. There are lots of reasons why you may not get paid. So eventually you may decide, we got to take this off and get rid of it. In the meantime, we're going to be sending them letters, we're going to call them, we're going to try to actively collect it. But very few businesses that extend credit always get paid for everything. So periodically, we're going to have to decide we're not collecting that. And when we decide that, what do?
write it off.
We write it off. Now, generally, when we write it off, that would be considered the direct write-off method. And the direct write-off method is not allowed. Why is it not allowed? Because it violates the matching principle. Now, let's illustrate this. We know that if it's December and it's owed since September, some people may want to write it off. Probably most won't. When we get to March, I think most will. So how many months should we use before we wrote something off? Okay, let's say 6 months. And let's say we have a December 31st year end. That means nothing that we're owed from sales in August, September, October, November, December, and maybe some of July will be written off this year. We made a sale in August, it's still owed at December 31st. It hasn't hit 6 months, so we don't write it off. When would we write that off if it's still outstanding? The next year, right? So we had the revenue in one year and the expense in the other. That violates the matching principle. We can't have that. We need to have the expense in the same period as the sale. So because of that, we can't use direct write-off. We use what we call an allowance system. That direct write-off method that I just said we can't use has a single advantage, and that's we know whose account we're writing off. It was Sophie. We're not getting the 400, let's get rid of it. The allowance method, we don't know whose account we're writing off, whose allowance this is. It's based upon total accounts receivable or total sales or some basis, not an individual customer. And there are three allowance methods we can use: percentage sales, percentage accounts receivable, or aging. So if during the year we made one sale, debit accounts receivable 1,000, credit sales 1,000, and then we granted a return, debit sales return, credit accounts receivable. Now it's the end of the year, and we're using method one. Method one, in our case, we use 5% of net credit sales. So if we had cash sales and credit sales, we only want the credit sales. And the net piece means it's net credit sales minus sales returns, minus sales allowance, minus sales discounts. So in this case, it's 1,000 minus 20. So net credit sales are 980. And then if we take 5% of that, what do we get?
48.
49?
8.
48? No, 49. Try it again.
49, yeah. It's in my head.
49, right? So what do we do with that? We debit an account called bad debt expense. And we credit an account called allowance for doubtful accounts. Bad debt expense is simply an expense that goes on the income statement. The allowance for doubtful accounts is a contra asset account. It has a credit balance, and asset accounts usually have debit balances. So on the financial statements, we would say accounts receivable, 980, less allowance for doubtful accounts, 49, net accounts receivable, 931. The other way we could show it is accounts receivable, 931, and in parentheses, net of allowance of 49. Either one of those two displays would be okay for the financial statements. Well, you're making faces.
I couldn't read it, but I got
Which couldn't you read?
the accounts receivable, right?
This one?
Just the receivable part.
I wouldn't say it's particularly neat, but it's certainly, you can make it out. That's accounts receivable, net of allowance of $49. So where do we get this 5% from?
Percentile of sales, you just establish what that's going to be.
Okay, so
Based on past performance.
yeah, same idea, based upon our experience. Suppose it's your first year in business.
You tell me, look at the industry and what it is.
It's all that fun stuff.
In the industry averages, ask your accountants, what do they usually see? It's an estimate. The second method, suppose we use 10% of accounts receivable. $100. What else? How much is accounts receivable?
1100.
It was in 980.
980, right? 1,000 minus 20.
So is it just 10% of the 980?
Oh, shit.
Yeah. Just 10% of the 980. In general, would you think the percentage used for net credit sales would be more or less than the percentage used if it was based on ending accounts receivable balance? In this case, I picked 5% and 10%. Could I have switched it? Would that make any sense?
Is there any sort of rationale for the numbers we picked, or the arbitrary?
There should be a rationale trying to estimate the amount we're not going to collect. So no matter which system we use, the percentages should try to lead us to the same number.
Is there anything sort of like industry specific, like in the medical field, a certain percentage?
You see, the problem with averages is you always have extremes, and you really care about your specific circumstance. You know, they say if you're sitting on a range that's on, and your feet are in the refrigerator, on average, you're comfortable. But neither part is probably feeling pretty well.
No.
Julian?
Yeah, the net credit sales will always be more larger figure than the actual account receivable.
Always?
Rolling on a month-by-month basis. Because you're going to have people paying you to reduce the accounts receivable.
Well,
So,
generally, yes, I agree with you. The only difference is if you've never gotten paid for anything over a couple of years, your sales are only from this year, but receivables are from all years.
right.
So generally, you're right. Generally, you would expect, since this is a bigger number than this, to come out to the same place, you could use a smaller percentage for sales than you would for receivables. Then that was the point we were going to get that, and you got it right. Now, the third, the aging, works differently. So let's just recap what we did. When we use percentage of sales or percentage of accounts receivable, our calculation gives us the journal entry. 5% of net credit sales is 49, 10% of accounts receivable is 98, debit expense, credit allowance. The aging works a little differently. The aging schedule is a useful tool. It takes all our customer accounts, all the amounts we're owed, and puts them in a grid. So we have a large list of customers that owe us money. Total we're owed is $500,000, and I've just listed 3 customer balances. There's going to be more, but I just didn't go through and list them all. The aging schedule tells us of this amount how old it is. Generally, it might be multiple invoices, though in some cases it might be one invoice. And you can have as many columns as you need. If we have a huge amount in 120 plus, my tendency would want to be to expand it. I usually want the last column to not have much money in it. Because then it doesn't really matter whether it's 180 or 210 or 240. But it might if it's a whole lot of money. And so we'll take this customer. So ABC, that's owed to us for the past month. DEF, half is from last month, half is from this month. So maybe it's a monthly payment. They give us $2,500 a month. How badly outstanding are those two payments? Well, maybe not so badly. This one could be 1 day later than a month, and this one was due to us yesterday. So we're really not going to worry too much about the 0 to 30, and maybe even not worry too much about 31 to 60. If we expect to be paid within 60 days, once we start getting out here, that's when we begin to worry. So we'll have a total for each of these columns, and that total should equal the 500,000. So the aging schedule takes all of our customers, lists how much they owe, and shows us how old it is, the age of the receivable. Now, the way this works for getting bad debt expense is we apply a percentage to each of these columns. And that percentage is the percentage we expect not to collect. So let's say this was your company and you were applying percentages. What percentage would you use for the 0 to 30 column?
90%.
How much?
90%.
90%? You expect not to collect 90% of this?
I expect to collect 90%.
So of every sale you made this month, you expect 10% not to collect.
Yes.
So 1 out of every 10, if every equal sales, 1 out of every 10 sale you make, you expect not to get paid for it.
Yep.
That seems awfully high to me. Well, let's put it down. My tendency would probably be to put 0% there. Why? Because what happens if we don't collect it this month? It moves to the next column, right? So I don't really need much here if it's going to wind up here next month. Now, theoretically, we want to increase as we go across. As you go across, the likelihood of collecting becomes less and less. So you want the percentages to go up as it gets older. When you start with 10, it makes it a little tough, but we'll leave it there. We're just illustrating how to make the entries. How about the 31 to 60? 15. 61 to 90? 91 to 120? I'm guessing you're going 25. And let's do 50% in the last column. I'd say in general, these are really high percentages. I wouldn't expect to see this, but we're just illustrating a point. So now we multiply 40,000, 3,000, 6,000, 10,000, 5,000. What does it add up to? $64,000. Now, if this was the percentage sales method or the percentage receivable method, we would debit bad debt expense 64,000, credit the allowance 64,000. But this isn't those methods. What this method tells us is what the balance in the allowance account should be. Our journal entry is going to depend on what the beginning balance in the account is. We're still going to debit bad debt expense and credit the allowance, but it's not going to be for the amount from this schedule. So let's say the beginning balance was 31,000. How much is the debit to bad debt expense?
$32,200.
33,000?
32.
32?
No.
33. So what I like to do is make the T account, put the balance as it is, the beginning balance, show what it needs to be, then make a little box I need to fill in. That's going to be my entry. So the first two methods tell us the entry. The percentage aging method gives us the balance. And the entry is what we need to do to get to that balance. Any questions about that? Okay, there's one more thing we need to talk about. We'll stay with this aging as our example. What's gross accounts receivable?
Total account receivable.
Total accounts receivable, not net accounts receivable, total accounts receivable. Looking for a number.
Oh, 500 dollars.
500,000. How much is the allowance?
64.
So net accounts receivable is 436. Now, let's say Sophie turns out to be a deadbeat. We don't want to have columns going out for years on this schedule. We don't think we're ever going to collect it. We want to write it off. We want to take it off the schedule. To do that, we debit the allowance and credit accounts receivable. It doesn't violate the matching principle because there is no expense. We're not recording an expense, we're adjusting the allowance and we're adjusting the accounts receivable. We've now just said the allowance is some amount we're not going to collect. Now we're specifying a piece of it, so we'll reduce the allowance, reduce the receivable. What happens to net accounts receivable? Go up or go down?
Total accounts receivable is going to go down.
Go down. Anybody go up? So the answer is remains unchanged.
Because the accounts receivable goes down and then the allowance goes up. So does it become a wash?
No.
No.
No. Think about it. What happens to accounts receivable?
Goes down.
What happens to the allowance?
Oh, it's reduced by 10K. So it's a wash.
It's a wash. Doesn't affect anything.
So that's how you count for one period.
A particular customer we want to get off the schedule. So what happens the next week? In the mail, we get a check from Sophie for $10,000. Are we compelled to send it back since we wrote off the account? Dear Sophie, thank you for your check. We wrote your account off. Too bad this check wasn't here a week earlier. No, deposit first, ask questions later. So what do? If we deposit the check, we debit cash, what are we going to credit?
Allowance?
But then for
Bad debt recovery allowance? Well, actually, neither case. The first thing we do is we reverse this entry. We put the receivable back and we restore the allowance. Then we record cash and we credit the receivable. Since we put the receivable back, there's something to credit. Any questions about that? Suppose we only got 5,000. We wrote off the 10, we get a check for 5. What do we do in that case?
Well, the same thing with 5 and 5.
The
But then what do you do with the rest that's been written off?
Well, we have two choices.
You can open it up again because they're good for it.
We can do this and then record cash of 5, receivable of 5, or we can just restore the amount we received. If we're restoring the amount we received, we say this is still a deadbeat. If we get another check, we'll restore that amount. But until then, we don't want to get our hopes up. Or you might say this is good faith. It's an indication they do want to pay us. Let's put the whole receivable back. So you really have two choices. Most people would just put back the amount they collected. And they said, if we get the rest, then we'll put the rest back. But it takes such a long time, and by the time we write something off, we're saying we've given up. So we don't want false hope. But either one technically would work. Any questions about the aging system? Two ratios, then we're done with the chapter. We can get to the homework. Accounts receivable turnover. The accounts receivable turnover is equal to net credit sales over average accounts receivable. And one thing to keep in mind when we do ratios is almost every single time we do a ratio that involves an income statement or a cash flow statement or retained earnings statement figure and a balance sheet item, you need to average the balance sheet item. The net credit sales are for a period of time. If we don't average the balance sheet item, then we're just taking it at one point in time. If you look up Investopedia, Financepedia, any of the wikis, half of them will incorrectly have ratios. So only use authoritative textbooks, things like that come out of accounting. Because half of them would just say accounts receivable. And if you don't average it, you have all this activity, but nothing in here. So by averaging it, we get the same beginning and end point as the period we're measuring. That works for all the ratios. But let's talk about the accounts receivable turnover. If our policy was we get paid every 30 days, what would we like our turnover to be? Rough numbers. You want to say it? You're just afraid you're wrong?
I'm not taking it right now.
What's 30 days equal to? A month. How many months are there in a year? So if our policy is we get paid in 30 days, we'd like our turnover to be about 12. Not exactly 12. If it's a little less, it means we're getting paid just the way we thought. If it's 15, it's really not too bad. If it's 80, we may have problems. If it's 150, we're supposed to get paid in a month and we're getting paid every 5 months. That's going to be a cash flow drain. So we could use this to measure what we think should be happening versus what is. And when you're analyzing companies, you're looking at the change from year to year. A company that starts out with a 30-day policy and has a receivable turnover of 12, that's going to 15, then 30, then 40, then 50, their customers are having problems paying, or their customers are unhappy with them. Either way, it's a bad thing. Another way to express this is days in accounts receivable. That's equal to 365 over accounts receivable turnover. So if receivables turn over 12 times a year, how many days are there in accounts receivable? It'd be 365 over 12, roughly 30. So 30 days in receivable approximately equals a turnover of 12. Every month, everything we're owed from the prior month is getting paid. And that's really everything important in the chapter. Any questions about what we covered? Anything you read you didn't understand? Okay, the exercises. Exercise 1. On May 7th, Juanita Construction provides services on account to Michael Wolf for $4,000. Michael pays for those services on May 13th. Record the service on May 7th and the collection of cash on May 13th. Now keep in mind the chapters we're in, because we could look at any one of these entries and take the other side of it. we're recording in sales and receivables the sale and the receivable side of it. To Michael, he's recording an expense and a payable. There's a symmetry of this. So the opposite side, they're going to record debit, expense, credit, payable. We're debiting receivable, crediting revenue. So always remember which company we are, and the chapter's a hint to that. We're the company making the sale, recording the receivable. So we make a sale for $4,000. What's the entry?
Receivable 4,000 credit sales.
$513 we get paid.
Credit cash 4,000. I mean, debit cash 4,000. Credit accounts receivable.
Any questions about one? Two, Mary Maiden's Cleaning generally charges $300 for a detailed cleaning of a normal size home. However, to generate additional business, they're offering a new customer discount at 10%. On May 1st, Mrs. Pearson has Mary Maiden's clean her house and pays cash equal to the discounted price. What's the entry on 5-1?
Is it debit cash 270? Credit sales 270?
So 300 less 10%. That would be my inclination. If we had made the sale of $300, and then the person said, I'm not all that happy with the job you did. And Mary Maiden said, well, we could come back and do more, or we could just give you 10% off. They said, well, give me back the 30, I'll take 10% off. Then I would do cash 300, sales 300, sales allowance 30, credit cash 30. But since you really sold it for 270, I would just record the 270. I wouldn't treat this as a sales discount or a sales allowance, just as a reduced price. Like if you walk into the store and everything's 10% off, they don't treat that as a sale at full price and a sales allowance at 10. It's just a lower price. March 12th, medical waste provides services on account to Grace Hospital for $11,000. It's okay, so this is 312. It's 11,000 in terms of 210. Whoops. 210 and 30. Payment is made 320. So what's the entry on March 12th?
Receivable 11,000.
Unearned revenue. Or not,
Sales. What's the entry on 320?
Is it cash 10,780? Sales discount 220. Accounts receivable 11,000.
So 10,780 is a discount of 220, which is 2% of 11,000.
And then sales discount debit 220.
What did you credit?
Accounts receivable.
Any questions about 3?
Is that a 780 or
780. 780. And 780.
That was this
Yeah, I get bad towards the bottom.
one. My vision is.
Yeah, I write very nice all over. It's just your vision. That's right. Table 4, same beginning entry, but the customer doesn't take the discount.
Well, then it's 1111, 1111, cash and accounts receivable on the bottom.
Debit receivable, credit sales 11, debit cash, credit accounts receivable. Six, we're skipping 5, I know. April 25th, Foreman Electric installs wiring in a new home for $3,500 on account. So what's the entry on 425?
Accounts receivable 35 and credit sales.
April 27th, the electric work does not pass inspection, and they give the customer an allowance of $600. So what's the entry on 427?
Allowance $600 and credit account receivable.
So sales allowance, 600. Credit accounts receivable, 600. The customer makes full payment of the balance owed and the tip-off, excluding the allowance, on April 30th. So what's the entry on April 30th?
Is it cash 2,900? Accounts receivable 2,900.
Yep. Any questions about 6? Seven. During 2018, its first year of operations, Pave Construction provides services on account of $160,000. By the end of 2018, cash collections on these accounts total $110,000. Pave estimates that 25% of the uncollected accounts will be bad debts. Record the adjustment for uncollectible accounts at December 31st, 2018. All right, give that a shot.
12,500
Bad
bad debt allowance.
Okay, so let's see. Sales, which also equals the debits to accounts receivable, are 160. Payments during the year were 110, leaving a balance of accounts receivable at year end of 50. $25% is the allowance in the bad debt expense. Debit bad debt expense 12.5. Credit the allowance for doubtful accounts 12.5. How much is net accounts receivable?
$12.5 million.
12.5?
37.
37.5. Net accounts receivable is equal to accounts receivable minus the allowance. So the net is 37.5. Any questions about 7? 8. Physicians Hospital has the following balances on 12/31/18 before any adjustment. AR is $60,000. The allowance is a credit balance of $1,100. At year end, they estimate uncollectible accounts to be 15% of accounts receivable. What's the adjustment for uncollectible accounts?
Is it 88.35?
Okay, one possibility.
Yeah, ask me.
No, it is not.
All right.
I prefer the game show approach
Yeah,
to it,
yeah.
but it's okay.
So I just, that's the part I didn't understand, even with the interest. Subtracted $1,100 from it.
No, it's based on 15% of accounts receivable.
But
How
yes,
much is accounts receivable?
it's 60.
So it's 15% of that.
If you had an allowance taken out of it, though.
Remember what we said. When you use percentage sales or percentage receivable,
Yeah, it's the whole, yeah.
it's the entry, not getting to the balance. It's the entry we made. So this is going to be 9,000. How much bad debt expense shows up in the income statement? Well, there'll be bad debt expense in the income statement.
$21.5.
Nope. 9. Right? We debited bad debt expense for 9. That's what's going to be in the income statement. How much is the net realizable value of accounts receivable? That's net accounts receivable. Is how much? Well, how much is accounts receivable?
65.
60,000 minus the allowance. How much is the allowance?
1100.
10,100. Right? We have this T account for the allowance. We start off with 1,100, then we post 9, The allowance has a balance of 10-1. So that makes net accounts receivable 49.9. So this question was how much bad debt expense is on the income statement? That's 9. The second part is how much allowance is on the balance sheet, and that's 10-1. So that makes net accounts receivable 49.9. Anybody still need this? All right, let's keep going. Exercise 9. Southwest Pediatrics has the following balances at 12/31/18 before any adjustment. Accounts receivable, 130,000. Allowance for doubtful accounts, $2,100 debit. They estimate uncollectible accounts to be 20% of accounts receivable. What's the adjustment for uncollectible accounts?
$26.
130 times 20% is 26. How much is bad debt expense on the income statement?
$23.9.
No. 26. Right, bad debt expense is 26. How much is the allowance for uncollectible accounts on the balance sheet? What do you think?
22.9.
23.9? Anybody else?
Don't you have to add up the bad debt with the allowance?
Well, let's make a T account. The allowance. What's the beginning balance in the T account?
2,100 debit side.
Debit side. That's a little unusual. It's supposed to be a
It
credit,
is confusing.
but it can be a debt. It could be anything. In this case, it told us it's a $2,100 debit.
Sometimes would it be a positive number?
You would expect it to be a credit.
Right.
So how does it get to be a debit? Well, we take last year's balance and the write-offs this year, where we debit the allowance, were greater than the credit, so we could end the year with a
That's
debit.
a positive.
It's possible. We're not going to try to rationalize or understand what happened. If the problem says debit, we just make sure we put it on the debit side. So when we post the credit, we know our balance is going to be 23.9. So that's what's going to be on the balance sheet. And 130,000 minus 23.9 is going to be 106.1. That's net accounts receivable. So I always like to do a debit and credit column for this so I could put the allowance in the right spot. And then if I need to, I'll make a T account just so I could visualize it a little better. so I don't accidentally add it when I should be subtracting. 10. Mercy Hospital has the following balances on December 31st before any adjustment. Accounts receivable, 70,000. Allowance, 1,400 credit. There's their aging with the estimated uncollectible percentages for each category. And they're kind of going with your percentages. Stuff that's not even due, they're figuring 15% they're not collecting. So go ahead. Estimate the amount of uncollectible receivables and record the adjustment. I'll give you a couple minutes. Thank you. let's take a look. So the first thing we have to do is multiply the amount times the uncollectible percentage. So there's 7,500, 2,200, 3,600, 850, 14, 16, 1, carry the 2, 5, 7, I get 14,150. So what do we do with that? We need to come up with the entry for debiting, bad debt expense, crediting the allowance. So what's our entry? What's the amount going to be in our entry? Well, we need a T account. So,
I think not yet due is 20%, right?
Yeah, do you have, I think it's 20, 15, 45.
are you using the third edition?
Yeah.
Oh, sorry.
Got it. So they flipped it.
They changed things. The problems have the same structure but different amounts. And I don't think yours is 12/31/18. 15, yeah. They figure a 3-year cycle for the books. So the ending balance is 14,150. The beginning balance is 1,400. So that amount is going to come from the box. What do we need to get our balance of 1,400 to 14,150?
Credit. On that side of it.
We need to credit. Yep, we need to get a credit of 14 to become a credit of 14,150.
It's 12,750.
12,750. So debit bad debt expense 12,750, credit the allowance 12,750. How much is the net realizable value of accounts receivable? It's going to be accounts receivable minus the allowance. So the net accounts receivable is going to be 55,850. So any questions from chapter 5? How about from any of the other chapters we did? Anything you want to go over, anything you don't understand? Since we're almost out of time, we use the rest of the class to just fill in any of your gaps. Anything at all? So we know the midterm